Here is a number worth holding on to: 294. That is how many members of the United States House of Representatives voted to pass the Digital Asset Market Clarity Act in July 2025, against 134 who opposed it. That is not a squeaker. That is a bipartisan landslide. And yet today, Thursday the 30th of July, 2026, that very same bill is appearing in headlines that use the word dead. CoinDesk put the question directly in its Crypto for Advisors briefing published this afternoon. The Bitcoin Foundation went further this morning, asking whether the entire crypto bull market is at risk now that the Clarity Act has, in its words, hit a wall. And Yahoo Finance reported yesterday, the 29th of July, that the bill is dividing America's largest financial institutions just as Congress prepares to leave Washington for the August recess. So which is it? Genuinely dead, or simply stuck? For anyone advising clients who hold digital assets, that distinction is not academic. It changes what you can promise, what you must document, and how you frame risk. Let us separate the political theater from what actually changes. The Clarity Act is market structure legislation, and that phrase matters. It does not try to regulate every corner of crypto. Its core job is to end the long-running turf war between the Securities and Exchange Commission and the Commodity Futures Trading Commission by setting out when a digital asset is treated as a security and when it is treated as a digital commodity. From that single definition flows everything else: which regulator oversees an exchange, how brokers and dealers register, what disclosures issuers owe holders, and how customer assets must be segregated from company funds. Compare it with the Genius Act, the stablecoin law signed in July 2025. That one reached the president's desk because it was narrow and largely uncontroversial. Market structure is the opposite. It touches banking, securities, commodities, and consumer protection simultaneously. And here is the procedural reality that so many commentators skip over. A House majority is not enough. The Senate writes its own version through the Banking and Agriculture Committees, and the bill needs 60 votes to clear a filibuster. Republicans do not hold 60 seats. Democratic votes are therefore not a bonus, they are a requirement. So what changed recently? 3 things, in quick succession. First, on the 13th of July, President Trump publicly called on Congress to pass the Clarity Act, framing it as a way to honor Senator Lindsey Graham, according to CNBC. Presidential pressure of that kind normally accelerates a bill. It did not. Second, and far more consequential, The Hill reported on Monday the 27th of July that the crypto bill was facing Democratic backlash over newly drafted ethics rules. Ethics language has become the sticking point precisely because it governs how public officials and their families may participate in digital asset ventures, and Democrats have made it a condition of their cooperation. Since their votes are arithmetically necessary, an unresolved ethics section is not a detail, it is a blockage. Third, the calendar itself. Congress is now moving into recess. Any bill that has not been reported out of committee before members go home loses momentum that is genuinely hard to rebuild. That combination, presidential push, stalled negotiations, and an emptying Capitol, is why the language shifted this week from delayed to dead. The most underreported part of this story is that the opposition is not simply Democrats versus Republicans. Yahoo Finance reported on the 29th of July that the Clarity Act is dividing finance giants against each other ahead of the recess. Traditional banking trade bodies and crypto-native firms want fundamentally different outcomes from the same text. Banks are concerned about deposit flight, about yield-bearing arrangements that compete with insured deposits, and about non-bank entities gaining access to payment infrastructure without carrying equivalent capital and supervisory burdens. Crypto exchanges and issuers want the opposite: a workable commodity classification path, a registration regime they can actually satisfy, and an end to enforcement-led rulemaking. When two well-funded lobbying blocs pull a bill in opposite directions, legislators facing a midterm election year tend to do the safest thing available, which is nothing. That is the structural reason this has stalled, and it is why simply swapping a few senators would not automatically unblock it. The disagreement is commercial, not merely partisan. Markets have been trading the disappointment. Forex.com published a Bitcoin forecast on the 22nd of July asking whether the Clarity Act could revive Bitcoin against the dollar from what it bluntly described as the dead, which tells you plenty about recent price action. CryptoRank ran a similar piece on XRP on the 21st of July, examining why it keeps crashing, dropping, and bouncing back. The common thread is that both assets have been trading on legislative expectation rather than on adoption fundamentals. When a regulatory catalyst is priced in and then fails to arrive, you do not get a neutral outcome, you get an unwind. For advisors, the practical lesson is about sequencing. Clients who bought in anticipation of a clean regulatory framework are now holding positions whose original thesis has been postponed indefinitely, not disproven. Those are different situations and they call for different conversations. One justifies patience. The other justifies rebalancing. Conflating them is how portfolios drift away from their stated mandate. Forbes made an important point on the 16th of July. The Clarity Act delay is now a compliance problem, not just a political one. That reframing deserves attention. Firms across the sector spent the past year building operational plans on the assumption that a defined framework was arriving. Custody policies, client onboarding questionnaires, suitability documentation, and disclosure templates were all drafted against a future rulebook. That rulebook has not materialized, so the status quo persists by default. In practice, that means asset classification remains contested case by case, oversight stays split between agencies without a clean boundary, and firms continue navigating a patchwork of state-level requirements in the United States. For UK-based advisors, the read across is indirect but real, because US market structure shapes global exchange behavior, liquidity, and product availability. The correct response today is not to wait. It is to document your existing framework properly, record why each holding is treated as it is, and make sure client agreements reflect current rules rather than anticipated ones. Now the outlook, based only on what we can see. The near-term picture is straightforward, with Congress heading into recess. Meaningful movement before September is unlikely. When members return, floor time is scarce and appropriations deadlines dominate the autumn schedule. Layer on a midterm election in November 2026 and the political calculation shifts again, because contested votes on crypto become campaign material. The realistic path forward runs through the ethics provisions. If negotiators reach a compromise that Democratic senators can defend publicly, the 60-vote mass becomes achievable and this bill revives quickly, because the underlying House support already exists. If those talks stay frozen, the more probable outcome is not outright death but fragmentation, meaning narrower measures on specific issues such as custody or taxation advancing separately, while comprehensive market structure slips into the next Congress. Watch two signals specifically: any Senate Banking Committee markup scheduled for September, and whether the ethics text is published in revised form. Those tell you more than any headline. So, is the Clarity Act dead? The honest answer, as of Thursday the 30th of July, 2026, is that it is stalled rather than buried, and the cause is a specific, identifiable dispute over ethics provisions combined with an industry that cannot agree on what it wants. A bill that won 294 House votes does not vanish. It waits. But waiting has a cost, and that cost is landing on advisors and their clients right now in the form of an unresolved compliance environment and assets trading on political headlines instead of fundamentals. Here is your takeaway. Stop pricing in a framework that has no confirmed arrival date. Build client documentation around the rules that exist today. Be explicit with clients that the regulatory thesis is delayed rather than cancelled, and treat September's committee calendar as your next genuine checkpoint. If this helped clarify a genuinely messy situation, subscribe for continued coverage as the Senate returns.